So in this session, we are going to look at how to do workback variances. Okay. Now, they don't really consider it as part of your exam, but I think one of the diets it appeared, you just have to know. So this is where you have the actual or the standard data being asked for, where the variances are rather given. So you use the variance to work back to get your actual or your standard information. Now, always I advise students who are doing work back variances to always consider the price variances first before they consider the quantity variances. That way, when you work, you actually get the figures quickly. Okay, so depending on what variances you have, you can work back. So first of all, you have to look at the requirements. It says, well, calculate the standard cost of materials and standard rate per labor hour and standard product cost sheet for 1 unit of product BM. Then your budgeted production units. So 12 marks. So how then do you do? So when you take the variance, then you work it. Now, when you look here, we have what direct material price variance coming first before usage, rate, then efficiency, then variable production overhead expenditure, then efficiency. No, so they said they operate a marginal costing system, meaning there's no fixed overhead capacity and then fixed overhead volume variance, right? Capacity and efficiency. They only have, I told you earlier on that under marginal costing, we only have fixed overhead expenditure variance, right? That's the only one we have. So they've given us the actual and the standard and the variances, right? So it's either they give you actual and then the variances, or they give you standard and variances, then you find actual. So it depends on what you have actually been given. So per this question, what we are going to do is we work with what we have. So I prefer that you do, this is what you do. So if I take material variances, because I'm using material, I'll put down, look at how I go about it. I put down my standard quantity times standard price, put down my actual quantity times standard price, my actual quantity at actual price, right? I know between this and this is usage, not so. So that means usage will therefore be what? Standard quantity at standard price minus actual quantity at standard price, not so. So I put this down. This is what I'm going to use to do the work back. Then here becomes what? We know here is price. So I can rewrite this each as what? Actual quantity at standard price minus what? Actual quantity at actual price, right? So now that I have this, I can now start working my variance. So when I come here, the first one I said is better you start with the price variance. So when I say material price, I know the material price is down here, this, so I use this. So I say price variance is actually equal to what? Actual quantity at standard price minus what? Actual quantity at actual price. So now I go with the data that I have. Now it is telling me that the material price variance is positive 30,000. That is 30,000 favorable, right? Then this 30,000 favorable is equal to what? Actual quantity. So you go through the actual information it has been given. Then they said direct materials purchased and used 30,000 and the actual. Remember, this is the actual information, right? So now they've given me the actual usage, right? So the actual quantity of direct material is 300,000 kg. Not so. But we don't know the standard price, right? Then they said actual quantity. We can see actual quantity here again, which is still what? The 300,000 kg. All times the actual price, they said that it was all this one was given at what? 420,000. So actual quantity at actual price is actually the 420,000. But if you like, you can divide and get the actual price, which is 420,000 divided by this 300,000. Okay. Now, actual quantity at actual price is the actual cost, which they've already given at 420. But if you think you want to get it again, then divide the 420 by the 300 to get the actual price and still put it there. When you multiply, you still get 420. So 420 divided by 300. That gives us 1 CD, 40 pesos, right? So I put the 1.4. That's the actual price. No, so which still gives you 420. Now that I have this, I can expand. with SP being my missing figure, my standard price being the missing figure. So I say 30,000 equals what? 300,000 SP minus 420,000, because this gives us 420, right? So now that we've done this, we can group like them. So we end up having 30,000 plus the 420 must flip over the equal sign. So this plus this gives us what? 300,000 standard price, not so? So in that case, this ends up giving us 450,000 equals what? 300,000 standard price. We divide by 300,000. We divide by 300,000. Not so? This and this should go. So what we have is that we have what? 450,000 divided by 300,000 to be our standard price. That means the standard price of material is 1 cedi 50 pesos per kg, right? So we've got the answer. This is as simple as it is. Now that we know the price variance, now when we come here, we need a usage variance. That's the next thing you do. So when you go, you say usage, and then you put the usage variance is equal to what? The standard quantity by standard price minus actual quantity by standard price, not so? But now we know the standard price. So you see, if you started with usage, then you would get confused and lose the question, right? Because you don't know the standard price. But when you start with price, that's the trick. You easily get the missing figures. So in that case, when we go, we know usage has been given to be what? 18,000 adverse. Adverse means it's negative. Then standard quantity, I don't know standard quantity, but standard price I know is 1.5, you know, so minus actual quantity, which I know is 300,000 times the standard price 1.5. No, so this 1.5, we calculated it at the 1 cedi 50 pesos for the material. So now we can work. We have negative 18,000, which is adverse variance, 1.5 standard quantity minus 300,000 by 1.5 gives us what? That gives us 450,000 also. Okay, 450,000. So what we can do is that we can group like terms. So 450,000 flips to this side minus the 18,000 gives us 1.5 SQ, right? So in that case, 450,000 minus the 18,000 gives us 432,000. Also, 432,000 equals 1.5 SQ. Now, we divide both sides by 1.5 and we should end up getting what the standard quantity is. Now, remember that standard quantity is always of actual output, right? Meaning the standard quantity that we have there has been multiplied by the actual units produced. Remember the flex. So this 432,000 divided by 1.5 should give us what? The standard quantity. And this standard quantity is actually 288,000 kg. Remember standard quantity, we want the standard quantity per unit, the standard quantity for just one unit. But remember that this standard quantity, usually when we are calculating the variance, always we multiply the standard quantity times the actual units produced, right? To flex it, the actual units. That means this one is actually some material kgs, not so, some material kgs times the actual units that were produced, 36,000 units. Per this question, you can see from here, we have 36,000 units that were actually produced. So something multiplied by this 36,000 units actually gave us this 288,000 kg. So how then do we get the standard quantity per unit? So our standard quantity per unit actually gives us what? The 288,000 kg divided by what? The 36,000 actual units produced. And what do we get then? That means that our standard quantity is actually 8 kg. So we use 8 kgs of material at 1 cedi 50 pesos. Okay, so we are done with that part. Now we need labor. So the same way, when you get to labor, I'll put my variance formula down so I don't get confused. I know labor is standard hour by standard rate, actual hour by standard rate, actual hour at what? Actual rate. Then I know between this and this is efficiency. In efficiency, I can rewrite it as standard hour times standard rate minus actual hour times standard rate. Not so. So you do the same thing for what? Rate. And we know rate is the difference between the actual hour times standard rate by minus actual hour at actual rate. Not so. So now that you have this, we can tackle labor. Okay. So you see, I put my formula at the top. And remember to always define your formula. So when I take labor rate, I want labor rate variance, not so. So rate, this is rate. So I know that the variance is given to me as what? Actual hour at standard rate minus actual hour at actual rate. So this has actually been given to us, right? So what then do we do? Let's start working. So labor rate has been given us 16,000 adverse, meaning negative, right? So actual hour, was it given in the question? So go to labor. It said direct wages for 64,000 hours, giving us total cost of 272. Now they've given it to us, the actual data in the question. So if we come here, actual hour was what? 64,000 hours times the standard rate. We don't know the standard rate, right? We didn't see it anywhere in the question for labor. No standard data was given. So 64,000 actual hour times the actual rate, which wasn't given, right? And remember that actual hour at actual rate is the actual cost for labor. And in this question, it has been given as 272, the same we saw for the material, right? But if you want to multiply here, you can divide the 272 by the 64 to get the actual hour, but we will not waste time here. Since you got the same concept from the material, we are going to do the same here, right? So this minus 272,000, which is the actual cost for labor. So now we can work out, and then when we are working this out, let's just let this cross. So you end up with your 272,000 positive here minus your 16,000, giving us was 64,000 SR. So we want to get the standard rate. So we do 272,000 minus 16,000. That gives us 256,000. 256,000 gives us 64,000 standard rate. So we divide by 64,000 both sides. Divide by 64,000 both sides. And then you end up with what? 256 divided by the 64,000. That means you get standard rates for labor. It's 4 cedis. That means standard rate for labor is actually 4 cedis per hour, right? We've got the standard rate. That's as easy as it goes. So now that you know the standard rate for labor, it is easy for you to calculate what? Your efficiency variance. And we know that when it comes to labor efficiency, you go back to your formula, you watch, okay, this is efficiency, right? So you come here, you say efficiency variance. Are you getting it? It's actually what? Your standard hour times standard rate minus your actual hour times standard rate. No, so then you put it down. So once you put it down, you come here, ask yourself, efficiency variance was what? It was 32,000 favorable. So it's positive. Standard hour, we don't know standard hour, but we know standard rate to be 4 cedis now. We know actual hour to be 64,000 hours times the standard rate of 4 cedis. You get the idea? So now that you have this, you are just going to expand this. So you have your 32,000 equals 4 standard hour minus 64 by 4. You realize we saw this earlier, which is the 256,000. No, so now we can work closely by bringing our 256,000 here. Because it crosses, it becomes positive, plus 32,000 equals 4 standard hour, right? So in that case, what then do we get? 256,000 plus 32,000. That gives us 288,000. Then you have 4 standard hour. Divide by 4, divide by 4. So 4 gone. No, so you have 288,000 divided by 4. That gives us what? 72. Standard hour gives us 72,000 hours. But remember that standard is always of what? Actual output, right? That means anytime we are doing standard, we multiply by the actual units produced. Since you are multiplying by the actual units produced, that means the standard hour is for all the units, but one standard hour per unit. So this one you have to divide by what it was flexed at the actual. So you divide by the actual units that were produced, which is 36,000 units. So in that case, how many hours per unit do we have as our standard hour per unit? So 72,000 divided by the 36 actual units produced, that gives us what 2 cedis per hour. Right, so material was what 1.5 per kg. This is 2 cedis per hour. So this is how you do it. You see, it's not anything difficult. The same way when we get to variable production overheads. Okay, so when we come here, variable overheads, the same way you put the formulas down as I've been doing. Also, so efficiency. By now, I hope you get the whole thing. Yes, so I'll not waste so much time. So efficiency will be our standard hour times standard rate, also minus actual hour times standard rate. Then when you come to what expenditure, it comes what actual hour times standard rate minus actual hour times actual rate, which is the actual cost. And also, this has already been given in the question. So let's take the variances one by one. You always start with the rate variance or the price, which is now expenditure. So I'm going to start with what? The expenditure variance for variable overhead. And in this case, the expenditure variance in the question was 12,000 adverse. So minus 12,000 equals what? Expenditure. So I'm taking it equals actual hour times that. Oh, I should have written the formula down so that you are all. So variance should actually give us actual hour standard rate minus actual hour by actual rate. Okay, by actual rate. By actual rate. Okay, so that's what we have. Now they are telling us this is negative 12,000. Now we need actual hours that were used, and overheads use labor hours in ICA variances. So 64,000 by the standard rate, which we don't know, right? But we know that the actual cost for overheads when you go to variable overhead was 60 what? 76,000. You can see it from here. 76,000 from this data that we have been given, 76,000, right? So now that you know that actual hour at actual rate is the actual cost for overheads, we've put that there. So now we can work, right? So 76,000 can cross, it becomes positive. Also, there's minus 12,000. So we subtract the 12,000 from here. And this ends up giving us 64,000 SR. Also, so 76,000 minus 12,000 gives us what? That gives us 64,000. So we have 64,000 equals 64,000 SR. So divide by 64,000, divide by 64,000 also. So 64 cancels, goes here one. That means the standard rate for overheads. The standard rate for overheads is actually what? 1 Ghana cedi per hour. No, I think we made a small issue. This one is not cedis. We are finding hours. Okay, for the labor, it should have been 2 hours per unit, right? So it's hours, not cedis. Okay, so we have 1 cedi per hour for the standard what? Rate. Now that we have the standard rate, we are done. Why won't we go and find what? The standard hour? Because it's the same as the labor hours we calculated. If you work with the expenditure, the efficiency, you are going to get the same thing because we are using the same labor hours. So the standard hour will still be the same, just like for the labor. Okay, so that is it. Now that we've got this, they said we should calculate the standard rate of materials and per labor. Then we should prepare a standard cost sheet for 1 unit of product BM. So this is what we are going to do. And it says we should determine what? The budgeted production unit. So how do you get your budgeted production unit? Under what case is the budgeted production unit used? So you ask yourself, where do I see budgeted production units? You can use the data that has been given to get your budgeted production unit. How would you do that? Somebody may ask. There are a lot of ways you can do it, but the easiest way is to prepare profit statement, your actual profit statement, and reconcile to your what? Your budgeted profit. Then divide by. Are you getting it? Once you get your budgeted profit, then you can use it to get what? Your budgeted units. That is how you can go about it. Is that okay? But first of all, let's prepare a standard cost sheet for 1 unit of product BM. So let's see, standard cost sheet for 1 unit of product BM. So standard cost sheet for 1 unit of product BM. Product BM. Okay. So in that case, what then do we have? We know that we have direct material. So for direct material cost, we know that direct material, where's our calculation? We can start with direct material, okay? So direct material is 8 kg at 1 CD, 50 pesos per kg, the standard price and the standard hour. The standard price, standard kg, so 8 kgs at what? 1 CD, 50 pesos per kg. Okay, so we have this. So we have 8 by 1.5. That gives us 12 CDs. Yeah, then 12 CDs. Now we need direct labor. Direct labor, we know that we were using 2 hours per unit at, they are taking 4 CDs per hour. You remember, 4 CDs per hour. So that gives us 8 CDs. Then when we get to variable overheads, we were taking what? One, you would also use 2 hours just like labor because it goes with labor hours, but the rate was what? 1 CD per hour, right? So in that case, that means it is 2. So if we should get the standard cost for this, should be what? 22, because it's 12 plus 8 plus 2. 8 plus 2 being 10 plus 12, 22. So this is how you deal with work back variances. But the whole thing is that if you're actually working with this, you should get your budgeted units. So how do we get our budgeted production unit? Now, let's get back to the data that we had. Okay, so in the next section, because of time, we are going to deal with that. But this is basically what we do when we are actually getting our work back variances and the production statement. This is mostly what is going to be asked during the exam.